Hello, welcome back to Campus Season Media. So this video we are going to be specifically looking at hire purchase, whereby we are going to be looking at the treatment of hire purchase in the books of first of all the seller. Then we shall end with we shall also look at double entries in accounting entries in the books of the buyer. And we are going to start by looking at, of course, the definition of hire purchase. We are going to look at the definition of hire purchase. Then we look at reasons why hire purchase price is greater than the cash price of the asset. And you look at some of the X-ticks. Then we shall pass the double entries later. So the definition of hire purchase, we define it as a means of paying for an asset whereby the buyer, all the ownership doesn't pass to the buyer until he pays the last installment, and the buyer has to also agree to the legal option of buying it. Then some of the ethics of hire purchase, you are going to see that, of course, our ownership doesn't pass to the buyer until he pays the last installment. Then payments are made in installments, another ethics of hire purchase. Then maybe they can ask you for reasons why the higher price is greater than the cash price of the asset. First of all, we have the first reason is to cater for time value of money. Time value of money. So you are supposed to pay. You are supposed to pay above the cash price of the asset because you are catering for time value of money. For instance, in scenarios whereby you don't know whether inflation is going to increase in the future or decrease, so to cater for those instances or those circumstances, you have to pay a higher price. Then secondly, you can look at the risks associated. Risks associated. Sometimes somebody may purchase an asset and fail to complete the payment. So to cater for those risks, we have to the higher purchase price has to be high. Then lastly, we can look at time value risk associated. Then the last reason we look at capital of the seller being tied up. Capital tied up. The capital of the seller is tied up in a way that he's supposed to be using his money for other things, but he's giving you the asset. He's supposed to be using an asset for doing his own business, but he's hiring it out to you. So his capital is within your hands. So you have to pay the higher you have to pay what the higher purchase price has to be greater than the cash price because you are using his you are tying up his capital, in other words. Then the accounting entries, of course, if you look at the books of the seller, we have the cost of hire purchase asset, cost of sales, or cost of hire purchase asset. Hire purchase asset. Of course, you are going to see that the double entry is initially this seller must have bought that asset. So you are supposed to be recognizing the double entry as debit, cost of sales or cost of hire purchase account, cost of hire purchase asset account. Then you credit his cash or bank account. So initially, this guy must have bought that asset is hiring out to the buyer, meaning that we have to recognize purchases increasing by debiting them. We call it cost of hire purchase asset. Then we credit our cash because you are losing money to get these assets. Now for the buyer, when he pays for that asset, initially. Now in the books of the buyer, initially this guy is going to acquire that asset. So he's supposed to recognize a non-current asset increasing in his account, in his business. Debit non-current asset because assets increase by debiting. Then we credit the supplier. Because you are just hiring this machine, the supplier is going to keep demanding him money. So it's going to be a liability increasing. Then you can look at higher purchase interest. Since you're hiring that machine, you must be paying interest. Higher purchase interest. In the books of the buyer, you are going to see that this is going to be an expense in the books of the buyer because you are going to be expending money because you are using that asset. So you recognize that asset, that expense increasing, debit higher purchase interest account. Then you credit the supplier. This guy is going to keep demanding you money for using that asset, interest. So you recognize the liability increasing. But in the books of the seller, the higher purchase interest acts as an income to him. This is an income. Higher purchase interest, this one is going to give this guy interest. So it is an income to the seller. So you'll be crediting that income increasing higher purchase interest account. Then it debits the higher purchase or the data increasing, or the buyer. Because it's going to keep demanding, it's going to be having an asset buyer increasing all the time, all the data. Then you can have higher purchase installments paid. Higher purchase installments paid. Of course, when this guy, the buyer, pays, he has to recognize that he lost an asset, cash or bank. He must credit his cash or bank account and recognize that liability reduced, because when you pay a supplier, he must reduce all the seller, supplier, stock seller, seller's account. But in this case, this one, higher purchase installments received. This one is paying. Now this side you have higher purchase installments received, because this is the one of the assets. Installments received. When he receives the money, of course, he has to debit his cash or bank account. Then he recognizes that a debtor, all the buyer reduces because he has paid in. So credit the buyer all the data. Then we can have transferring the higher purchase interest, the profit and loss. When you check the higher purchase in the books of the buyer, we opened up higher purchase by debiting it. So it means we have to close it off, transferring higher purchase interest to profit or loss account. Meaning that since we opened it by debiting, we have to close it off by crediting it. Credit higher purchase interest account, then debit the profit and loss. We are debiting profit and loss because when you debit profit and loss, you are recognizing an expense. This higher purchase interest must be an expense in the books of the buyer. So we are debiting income statement to recognize that it's an expense. But when you are transferring, in this case in the books of the seller, transferring higher purchase interest to profit or loss or the trading account, we shall pass the debit and credit. Obviously, we opened it by crediting. We have to close it up by debiting. Debit higher purchase interest account, then credit the profit or loss, or you can call it trading account. You can have the trading account. Then lastly, what else? So the last entry in the books of the seller, this is the 1, 2, 3, 4. You can have higher purchase sales. When this guy makes that sale, higher purchase sales. Because when he sells, you are supposed to be crediting the higher purchase sales account, because sales increase by crediting higher purchase sales account. Then you recognize that the data is increasing. We are selling, but we are just hiring that machine to that data. So the buyer, you debit the buyer all the data. Then in the books of the buyer, that guy is supposed to cater, the buyer is supposed to cater for depreciation. Of course, depreciation, we pass the number entry for depreciation. Debit depreciation, credit accumulated depreciation. Okay, so in relation to what you have just seen, the double entries we've seen in the books of the buyer and the seller respectively, but we are going to start with the books of the buyer, and we are going to be doing that number of a customer who bought a machine from Kwega Investments. The details are given and everything is given, and they're asking us to record the above transaction in customer's books. And when you check the question, customer is our buyer, is the buyer in this case. So we are going to see how we are supposed to be working out that question. So initially, when you check the question, they have told us to record the above transaction with above transactions in customer's books. Customer is our buyer. That's why is preparing the supplier's account here. So we start. Initially, you record the cash price of the asset. When you buy the asset initially, you're supposed to be debiting the non-current asset increasing. And the issue will be the supplier. That is initially. With the cash price in the question was 2,000. Then you credit the corresponding credit has to go to the supplier's account machine, which is 2,000. So that is at the beginning of the year. Then they told us that the higher purchase price is 2,300. Of course, that's going to be our purchase price. Then they told us that, of course, you are going to see that initially, the higher purchase interest, you as the buyer, you calculate it on the cash price. That is for the first year only. You calculate on the cash price, and they told us it is 10%. They told us the rate of interest was 10% per annum. So 10% of the cash price, which is initially it was 2,000. So of course, 10% of 2,000, you are going to be getting 200. 200 to the double entry for your purchase interest. You recognize an expense, so you debit the supplier, the higher purchase account using supplier as the detail with 200. Then you go ahead to recognize the supplier increasing here with higher purchase interest as the detail, which is 200. 10% of that. Then when you go to so on payment, we are supposed to pay. They told us we are supposed to pay 1,000 in the question plus the interest. So in the first year, of course, 1,000 plus the interest. We've seen our interest is 200,000. So you're supposed to pay 1,200. And when you pay, you're supposed to be crediting your cash with the supplier, which is 1,200, because this is the money we pay. Then we debit the supplier because it's reducing with our cash, which is 1,200. Of course, now when I close off the accounts, this one is supposed to be closed off to the profit and loss in the first year, 2,200. So it means it is on the credit to the profit and loss. I bring it as an expense of higher purchase interest of 200. Then I close off the machine account. Of course, this is the opening balance. The balance carried out at the end of that year will be 2,000, which will open next year as balance brought down to 2,000. Then this account of the supplier, I can balance it off to know the outstanding amount at the moment. This is 2,200, and then this is 2,200. Of course, the balance carried down in this case will be 1,000. So it means it's going to be the opening balance next year. The amount of money they are demanding you, your supplier, balance brought down is 1,000. So we repeat again, passing the entries starting from the outstanding balance. The outstanding balance now in this year is 1,000 for the supplier. It means that now we are going to be computing the higher purchase interest based on the amount outstanding as at this moment. So 10% of this one, you are going to be getting 100 shillings. So that's our higher purchase interest in this case. So you have to recognize that the second year, we are supposed to pay the supplier 100 in relation to interest. Then we recognize that the supplier is increasing higher purchase interest by 100 shillings. Then, of course, now this one you can. They told us that payment was 1,000 plus the interest. So in this case, in the second year, it is 1,000, but in the interest in this year is 100. So I recognize that 100. So it is 1,100 as payment. When we pay, we credit our cash supplier, going to the supplier 1,100. Then we recognize that the supplier reduced cash, which is 1,100. So this is the credit and this is the debit entry. At the end of the day, we can balance off our accounts. This one you can close it off. You have to close it off the profit and loss. So in the profit and loss, it's 100. 100. In the profit and loss, I must recognize that in the second year, I pay higher purchase interest of 100. Then, when you close off this account, of course, this one, if you close it off balance, carry it down, it's going to be the same because you don't dispose it off. When you balance off this account, this is 1,100 and this is 1,100, meaning that they are no longer demanding you money. So, yeah, that's it. So just in case they ask you to prepare the transactions, the books of the seller, of course, using the same example, you are going to see that in the seller's books, instead of having machine account, we shall be having what they call cost of hire purchase account. Cost of hire purchase account, whereby this one is going to be recording. Initially, we as the sellers, we must recognize that we bought that asset. So we credit cost of hire purchase account. So we will be, in other words, we will be debiting cost of hire purchase account with the cost. In this case, with the cost, they will always be giving you the cost. So you debit the cost of hire purchase account with the cost. Maybe they told us the cost is, let's say 3,000. So you recognize that 3,000. Then the corresponding credit entry has to go to your cash or bank account, because initially you buy it and you lose money. So we shall be debiting cost of hire purchase account with cash. Then our cash account, we shall treat it as reducing initially, going to the cost of hire purchase assets or cost of sales, 3,000. Then when you go to higher purchase interest, of course, in the books of the seller, higher purchase interest is an income to them. So instead of recording this side of the debit, because in the books of the buyer, we are debiting recognized expenses, but in this case, we shall be having the 2,200, the interest, as incomes this side, and they are coming from the debtor or the buyer. You write the buyer. And of course, this account will return, because since you are the seller, you have to maintain the buyer's account. So this will be the buyer's account, and this higher purchase interest, we shall be passing it on the credit side. Then Then of course, when you receive money, installments received, you won't be crediting your cash account. You'll be gaining. You'll be gaining. So this payment of 1,100 and 2,200, 1,100 and 1,200 and 1,100 will be on this side as 1,200 and 1,100 in respect to the data or the buyer. Then of course you are going to see that the higher purchase interest, of course, we shall be close. So we have said installments for us, we shall, in the books of the seller, we shall be recognizing them as increasing our cash because we shall be receiving money. Obviously here you have to debit the buyer. You are going to be debiting the buyer, increasing, I mean reducing, because it's going to be paying us. So the buyer must reduce here. I mean the buyer is going to be reducing because it's going to be giving us money 1,200 initially. Then this was 1,200. Then that's the first year. In the second year, you must also recognize cash being lost, cash being received by 1,100. Then, of course, the higher purchase interest, we are going to be closing it off the profit and loss for both years, meaning that since we are closing it off the profit and loss, we have to recognize credit entries instead of recognizing expenses. We are supposed to recognize incomes this side. Buyer, which is 200. In fact, higher purchase interest, 100. So that's it. You just simply do the opposite. As long as you know the accounting entries in the books of the seller, you just be reversing the entries. So basically, that's what we shall see happening in the seller's books. We shall just be reversing what? The double entries. Thanks for watching. So this is all for higher purchase. So we request you to subscribe for more videos as we are going to be coming up with other videos of maybe leasing and container accounts. Thank you.